and welcome to ETF Edge, your go-to place for everything exchange-traded funds. I'm your host, Bob Pisani. Two big stories in ETF land to start the fourth quarter. The first, Ether ETFs, futures, and big inflows continuing into bond funds. Let's talk with Simeon Hyman. He's the head of investment strategy at ProShares. Brian Lake is the global head of ETF solutions at JP Morgan Asset Management. And Todd Sohn is the ETF and technical strategist at Strategas. Simon, today you launched three new ETFs right here at the NYSE. ProShares Ether Strategy ETF. EETH there. I did the symbol for you.
There you go.
Good for you. Tell us about what's going on here. Now, this is Ether futures, similar to Bitcoin futures, but explain what's going on.
Just like we launched with BITO 2 years ago, had a lot of success, $2 billion in flows, top 5% of volume on the exchange. We know that futures, regulated futures market in an ETF is a great solution. Today we launched that in the Ether space, EETH. It's ProShares Ether Strategy ETF. And then we launched two combos, BETE, which is the Bitcoin Ether equal weight, and BETH, which is Bitcoin Ether market cap weight. So we have a full suite of crypto solutions with the largest crypto ETF provider.
Yeah, I remember I had you here the day we launched BITO. It is the biggest Bitcoin futures ETF that's out there. Speaking of Bitcoin futures ETF, I've got to ask you about where the Bitcoin future, the spot one, is. We all know what happened. The SEC lost the Grayscale case. Gary Gensler had 45 days to appeal that. We're sort of waiting for them to make a decision. What's going on with the spot Bitcoin ETF right now?
Yeah, I think none of us know exactly where that's going to take or how long it would take or what form that would be when it's all said and done. What we know is the futures ETFs are here today. And what's important about that is that regulated futures market. It resolves a lot of the challenges as the spot market is maturing. All the news we saw the last year or so with the exchanges and those things, ultimately they'll mature. But in the meantime, a future solution is there and it works real well. BITO 2 years out.
Yeah. Since
its inception, 3% off spot Bitcoin. Most of that is fee and nothing is free to invest in. So it works really well.
Grayscale won the case against the SEC. Basically, the court said, you guys approved a Bitcoin futures ETF. They are like products. You prove that, you got to approve a spot Bitcoin. Now they've got an Ether futures ETF. Is the implication here that there's a good chance of getting a spot Ether and a spot Bitcoin? Or am I stretching this?
You would think so. It's a matter of time, right? And the way I'm looking at this with the indulge of product that's come to the market is it's rare when you get a new asset class, right, to enter into the ETF lexicon. We've had equities for some time. We have bonds, commodities. Crypto seems to be the next step. It may not be for everyone, given the volatility involved, but I can understand from an issuer's perspective why you'd want to try and take advantage of that market. We'll see how the asset class performs, but again, this is a new area for everyone to get involved into. So I think that's why you're seeing such popularity with all these releases.
Brian, you want to handicap the odds of a spot Bitcoin ETF that may be a little out of your ballpark, but you're an old ETF watcher. You've been around a long, long time. You know this game.
I think it will happen. I don't know when.
Okay. Very politic of you. All right. I'm not going to let you. We're going to go back to the. I'm not going to give up on the spot Bitcoin. Guys, this is people like this story too much here. But let me turn to you. Big inflows continuing into money market and short-term treasury ETFs. Investors are loving these 5% yields. You can't get them to stop talking about it. They seem very happy to stay in their 5% treasury yields. But now we've been seeing inflows into short-term investment grade corporate bonds recently. You've got this ultra-short income ETF, JPST, that's getting inflows. I'm a little puzzled about this. What's the appeal of corporates, even short-term corporates, over treasuries? Different risk ratio here.
Yeah, well, when you look at kind of peak cash levels like this, it tends to be the worst performing asset class once you stretch out over time because everything else kind of does better. And so the ultra short space is actually really interesting right now. You can do what we call step out of cash, and you're able to incorporate with an investment grade that's now, our PM was emailing me over the weekend, he's buying paper 5.8, 6.2%. Your SEC yield on JPST right now is 5.38%. That's a nice step out of cash right now, versus like the ag, for example, Bob. Ag, you're getting 108% of the yield with only 10% of the duration. And so that's actually a pretty attractive place to kind of hang out in these markets.
And of course, ag is the biggest bond ETF out there. Although, wait, Vanguard Total Bond, I think, is bigger, right, Todd? Vanguard Total Bond is bigger than ag.
They're neck and neck around 90, low 90s. I'm waiting for one of them to hit 100 billion, actually.
Yeah, that'd be big
for the first
big
100
story.
billion.
Anyhow, his point is ag is sort of the whole bond market, essentially.
Right.
But you've got 5.3% on this JPST. Investment grade debt, but the risks are higher. This is what I don't get. Corporate debt has higher risk than government debt, right? You all know that. So what's the advantage of having
Some of the corporates got higher credit quality than the U.S. government right now. We're only taking on 6-month duration, and so we've got it nice and tight in there. So you've got very attractive credit quality. We've got an active manager that's individually selecting each of the bonds that are going into the portfolio, which I think, particularly on the fixed income side, is a very differentiated proposition. And this product's got a ton of track record. It's been out for over 5 years. It's the second largest active ETF in the world. So we think JPST is a great place to be looking right now.
Boy, what a surprise. He likes his product. Is this a permanent change in consumer investing behavior? I'm a little worried about this. Our bond funds, you people love these things. Are they going to pose serious competition for investor dollars? I mean, they haven't for decades, and yet everyone keeps messaging me, hey, Bob, we're happy at our 5% yield, 2% real yield. We don't care about the stock market.
As long as you're in this higher for longer environment, this is candy, especially after not having it for 10 plus years during the QE era. You now just put a bowl of M&Ms in front of a child who can get that 5%. I think that's the analogy I like to use. I also think a big understatement is that when you go out on the curve, you're getting equity-like volatility in a bond product, right? TLT has the same standard deviation as the S&P 500 roughly right now. So I think that's why you're seeing all this money go to money market funds or short duration products.
TLT is the 20-plus year bonds.
Right.
Those of you who don't understand his clipped way of speaking English.
Duration makes sense when the Fed is done hiking in anticipation of cuts. But if no cuts are coming, I don't think you want that volatility. It's not fun to sit in. I'd rather be in that short duration treasury or corporate.
And what about the old pitch? Oh, active management. Have you heard this story before? Active management can move a lot quicker. We've heard, here we go, active management. So
active management, I think, is much more comfortable in a bond wrapper, right, than an equity wrapper. Beating the S&P 500 is tough enough. Beating the ag is different because the ag doesn't have high yield in it, I believe, or it's a limited amount of high yield. So there's more opportunities to outperform when you're active, and especially going across the whole duration spectrum.
Yeah.
Bob, you'll like this. We think of active management versus passive management as black and white TV and color TV, and it's exactly to the point that was just made. A passive index is just going to give you just that. It's the duration of the index. There's no security selection. You're going to drift with duration, whereas active management can pull in not only...
Do you agree with his point that active is better served in a bond wrapper than in an equities wrapper?
I think active management on the fixed income side is a very compelling story, particularly given the way that passive fixed income and benchmarks are constructed.
So that's a yes?
That's a yes. That active management.
I'm trying to get a JP Morgan guy to admit that bond funds are better in an active
Well, that's
wrapper.
great. The reason I answer it that way is because I want to make sure that we're framing it the right way. When we're saying versus the field, I think that's a difficult thing to say. I think good active management can absolutely provide a tremendous amount of value. We just to give you our bona fides, we've got over 1,000 active managers. We spend $400 million a year on research. We're putting good active management into this, and it depends on the outcome that you're trying to deliver, right? So we just launched a product last week. I know you make fun of me for launching products, but we're doing this on behalf of investors. We're listening to investors. What do they want to see in the marketplace? So we launched Hedged Equity Laddered Overlay. The ticker, wait for it, is HELO, pronounced hello. So we've got cardboard cutouts of Adele around the office because she's got a great song, Hello from the Other Side, right? And this is designed to give you 2/3 the upside of the S&P with only half the volatility. Maybe an attractive product for the markets, like you're saying. Maybe we grind to the end of the year a little bit here, and this is a way to stay invested for the long run.
He just sold us his new product. Hello, HELO.
Hello.
You got it in. Very good. He's so media trained, it's annoying. It really is. Now, you've been around a long time. You have any thoughts on this Treasury craziness? I mean, their point is if you think inflation is going to cool off this quarter, the risk-reward in Treasuries is pretty good right now, right?
There are opportunities, but it doesn't have to be active per se. Rules-based strategies that do things that aren't exactly the same as the index can add value. For us, we have an ETF ticker IGHG. It's investment grade interest rate hedge corporate bonds. What's cool about it is it takes that spread and staples it to Fed funds. In effect, you're actually getting about 6.5% yield staying in corporates, but you have zero Treasury interest rate risk. You can do that in an ETF. It used to be called credit arb. You can do it in an index. So it doesn't have to be active in the capital A sense.
Does it bother you that these ETF products are getting more and more complicated? I used to have a hard time explaining covered call strategies. Now I got to explain even more complicated products.
Those are the hedged interest rate products are fascinating to me. They have done phenomenal since we've had liftoff of the interest rate cycle. But to your point, it's a little bit more complicated than a simple Treasury ETF. But I do agree with Simeon that they've done fantastic. They're a great way to hedge out the duration risk for now until we see cuts whenever that comes.
So you just heard both of these guys have new products that they're selling. And here's something interesting. 69 ETFs launched in September. That is the largest ETF launch in history. That's according to Todd, who actually watches this thing. Kind of sad, isn't it? That's what he does for a living. What happened? Is that true? This is the largest number of ETF launches in history we had?
This is true. We had a handful of launches from a few different families, right? And this is the acknowledgement of the ETF space from legacy fund providers, boutique RAs who maybe have a separately managed account they want to put in an ETF. There's the day trading crowd, right? Those issues who want to cater to them. And it's all coming together right now. The ETF industry is 30 years old, but based on launches, it feels much younger than that. I don't know if this number will get broken again. I think it's reasonable that it can, especially if some more legacy providers come in, but it should continue.
It's the start of the fourth quarter. Wouldn't it make some sense, Brian, that you try to launch a bunch of ETFs now before the end of the year? Does that?
Yeah, there's a push to get things done. Obviously, we'll be able to clip a 1 year performance number quicker this way, in the sense, obviously not a 1 year, but get a calendar year. So you sometimes do see some seasonality in launches. I think it's great for investors. You now have more variety to build the perfect portfolio for what you're exactly trying to achieve. Where the difficulty is you've got to sift through more of these to find the right ones. But variety is good.
Variety is good, but it's also confusing. A lot of these products I can't explain on television. It's really hard. I have to think very carefully, and it takes 30 seconds to do it. And even then, you're not sure exactly about the use case. Is there a trend in anything that's going on here? What's happening in these products? Because we know ETFs follow trends, for example. Remember when thematic tech was a big thing in 2016 and 2017?
Thematic tech, hedged equity, to Byron's part, is popular. Managing downside risk, I think, might be the proper way to put it.
That makes sense.
Especially because when you look at the demographics of asset management, there is a lot of folks close to retirement with a lot of money, and they want to protect that. And they still want their equity risk, though, right?
That makes sense to me.
And I would also just point out, we just had a record launch month, like you said, but there are still about 2 or 3 times as many equity mutual funds as equity ETFs. So while it may feel saturated and confusing, we're nowhere near where that space currently is. There's room to run.
This makes perfect sense to me, what he said. Older people interested in hedge products. So I'm the classic baby boomer. I'm almost 68. I am the classic baby boomer. 56 and 57 were the 2 biggest years for the baby boomers. And I have friends down here who said, Bob, people in our age group, when you're heading towards 70, you can't have another down 20% year. That's kind of risky. You've got to de-risk in terms of your equity exposure at that point. So the rise of these hedged products make a lot of sense for baby boomers who want to sit there and say, well, I'm not that dumb. I'm not going to sit there in 5% treasuries. That's too little risk, but I got to have some exposure to equities. Therefore, I'll give up some upside risk. There's Jeppy. You haven't gotten an ad for Jeppy. He hasn't talked about Jeppy yet. I can't believe it. But there's a product that makes sense for the times.
Yeah, but Bob, you just said you couldn't explain the strategy on TV, and you literally just did a better job than I did. That's exactly what
Jeppy is
was
basically that strategy.
Well, but Jeppy gives you the covered call, so you're selling a little bit.
By the way, say what
upside.
Jeppy is, so you explain it to the viewers.
Jeppy is a covered call strategy on a basket of quality securities. The idea to give you a premium income, so you're getting the dividend from the underlying plus the option premium that comes along with it.
Right.
Yielding.
So you're collecting a premium, but you're giving up some of the upside. So this works great in a year, in the second half of the year where we're having troubles. There you got a strategy that works. But in an up market, you are giving up. upside.
A covered call strategy is going to struggle in a straight up market. Yes, because you've given up some of that upside, you're going to be clipped on that. If you think we're going into a straight up market right now, maybe it's not the strategy for you. My view is we're going to grind a little bit to the end of the year here, probably be pretty range bound. JEPI and its NASDAQ cousin JEPQ, JEPQ is the other ticker. Both of those seem to be really optimally positioned right now.
You got in the other one, JEPQ. See, you're going to hit the whole. You're making your PR people very happy over here.
The whole family here. But this is innovation, right? Think about like another industry. So if we went to Ford Motor Company and you said, why are you innovating with these seat belts and all these airbags? Of course you are, because it's better for the end consumer of those. And that's how we think about it. You know, we think about fiduciary active management. What are things that we can put into these products to help investors get better outcomes?
Did he just call me an airbag? I think he just did. What happened there?
No, you're the seatbelt in that analogy. You're the driver. You're driving this car.
Look how fast he recovered on that. Very good. I want to return to get more out of you on the Ether futures. Yep. You got two other products that you launched today. These are both of them have exposure to the returns on Bitcoin and Ether. Now this intrigued me. Why do we need the combination of them? What is it? What's the appeal here?
We've launched BETE, which is Bitcoin and Ether equal weight, and BETH, which is market cap weighted. Look, they are the 1 and 2. These are the two largest cryptocurrencies. If you want exposure to both, you know you want exposure to both. It made a lot of sense to launch the combined products. There's two slightly different things, and we could talk about this for hours. Bitcoin, fixed supply. Ether, not fixed supply. Ether gives you exposure to the Ethereum ecosystem. Bitcoin is proof of work, and Ether is proof of stake. We got all sorts of little things here. Bottom line, the 1 and 2 cryptocurrencies, offering them combined for folks who want one-stop shopping.
I think the major thing to me is, and the reason I like Ethers is DeFi in general, but smart contract concepts too, that seem to matter a lot, which is a very different concept than when you're dealing with Bitcoin, right?
There's so many aspects to this, you know, whether it's your, and the way it can work in a portfolio, whether you view it as digital gold, whether you view it as a alpha satellite. What we know is the correlations are low to stocks and bonds, and that's super important because we know correlations in traditional asset classes are going to 1 rapidly for everything. Even stocks and bonds often do the same thing, and have an uncorrelated asset class is very important.
Yeah. I just want to move on, talk about a couple of other things. I think the key point here is you're almost acting like you want a diversification in stocks, and if you're in the crypto universe, you almost want a diversification a little bit in the two biggest ones here. That's what it seems like. It's maturing. It's a sign of maturation to me.
Absolutely, and they don't. Obviously, Bitcoin and Ether are more correlated to one another than they are to traditional asset classes. But for sure, it makes a lot of sense to have exposure to both the number 1 and number 2 cryptocurrencies.
Todd, I look at the top inflows this year. Mm-hmm. I see S&P 500 usual, IVV, VOO. These are the S&P 500 funds. They keep getting inflows. I also see an awful lot of bond funds in here. 20+ year treasuries, short-term 0 to 3 month treasuries, total bond BND, all big inflows. Your thoughts as we enter Q4 here? What ETFs are going to be working in Q4?
So the inflow list, it's your typical who's who, right? Folks allocating as they need to. Drilling down and watching more equally weighted ETFs, your equal weight S&P 500, RSP, equal weight Russell 1000, EQAL, because that's key for market participation and durability. We know the influence of the top 5 or top 10 stocks. I need to make sure that the bench is being involved in the market here. I want to keep an eye on semiconductors, XSD, SOXX, and housing as well, ITB. I think those would be good tells on the strength of the underlying economy. Things seem pretty good, but those have consolidated here after a pretty rough quarter. So I do want to keep tabs on those.
I'm looking at Lennar over here. Lennar had a great earnings, talking about housing ETFs, had a great report September 15th. Stuart Miller, business is good. They're taking business away from existing home sales because the high rates, people are sticking with their mortgage. They don't want to move. Yep. The report was great. They beat on the top and bottom, and stocks, it's been straight down because you can't fight the macro here. When you get a rise in yields this rapid, investors say, sell consumer discretionary, sell autos, sell Lennar. We don't care what what everybody's saying right now. And it's really kind of sad to see. Generally, business has been good, and yet they're acting like business is going to be terrible.
This most recent leg up in interest rates around the world has caused more agitation than the entire year, really. You're starting to see the more cyclically oriented areas underperform, whereas for most of the year, they were in pretty decent shape.
So we're seeing new lows today on all the big utility ETFs, all the big REIT ETFs, that you might expand, a lot of the bonds to new lows. But I'll give you an example of the effect of larger interest rates. The biotech ETF just hit a new low because funding costs for all of this stuff goes up. So this is a good example of how it affects virtually the entire ecosystem of investing in the United States. The biotech ETF has been, or is it IBB, has been affected by
that impacts small caps too, because they have a heavy presence in Russell 2000. So you can't buy biotech, you can't buy small caps then. You got to just stay up the scale in quality.
All right, enough of my ranting. Three of the best here, guys. We're getting you the best people. These are the top people in the industry for you. That does it for this week's ETF Edge. My thanks to Brian, Simeon, and Todd. We've asked Simeon to stick around, give us his perspective on where Bitcoin and crypto ETFs are going in the fourth quarter. Remember, you can see all of our shows on our website, etfedge.cnbc.com. Everybody have a healthy, happy, and safe trading week.
Get the ABCs of ETFs with the ETF Edge newsletter. Your weekly update on the hottest trends, expert analysis, actionable ideas, and exclusive insight from host Bob Pisani. Sign up now at cnbc.com/ETF Edge newsletter.